Hello, Matthew Bell with InsurancePrescription.com. Today I wanted to go over three kinds of diversification. Some of these are probably fairly well known. The third is as important, if not more important than the other two, and it's one that a lot of people don't know about. So first, let me just give a very basic framework for understanding the conversation. Diversification, diversify, and other related forms of that word basically have to do with variety. So just think adding variety into something. If you diversify something, you add variety into it. Now, in terms of investment and financial type instruments, diversification is usually thought of as a risk management strategy or as a risk mitigation strategy. That is to say, by adding variety into your portfolio, you are going to minimize your risk. We'll kind of talk through a number of examples of that in just a second. But the basic idea is that you're going to spread your money around so that you're not exposed overly much in any one thing because you are putting your money into a variety of different places. You can think of it as don't put all your eggs in one basket. It's basically one way of thinking about diversification. Now, the first sense of diversification then is having a diversified portfolio in the sense that I think a lot of people already are familiar with. And I'll start with this to just kind of give you a fix on the conversation. So the idea behind having a diversified portfolio is that, let's say you're not all invested in Amazon. No matter how great Amazon is, you're not putting all your money in Amazon. You're not putting all your money in Netflix. You're not even putting all your money in Amazon and Netflix together because you're having too much money in both of those companies, or so the thinking goes. Because the problem isn't when things are going well, the problem is when things start going badly. If you have all your money in Amazon and Amazon takes a hit for whatever reason, then all of your money is affected. Similarly with having your money in any one company or in any one instrument. So the first idea of diversification is just to put a little bit of money in a lot of different companies so that you can spread that risk around. But in addition to just putting money into many companies, another aspect of diversification, which is very related, is going to be don't put all of your money into the same type of asset or same type of investment. So don't put all of your money into company stocks. Maybe put some of your money into bonds and some of your money into exchange-traded funds and some of your money into commodities and so on. So the idea being not just spreading your money around in one asset class, but spreading your money around over various asset classes, and for the same reason, to reduce the exposure that you have to risk in the event that one of those companies or one of those asset classes takes a hit. Now, mutual funds are sometimes designed to try and provide this kind of diversification without you having to think about it. So you can think about it as automated diversification. So instead of you having to select 100 different types of company and 100 different types of asset class, you're able to simply purchase a mutual fund, purchase shares in a mutual fund, and in fact, by doing that, the mutual fund is diversified, or so the thinking is, and then you are able to achieve a diversified portfolio without you having to go through the mechanics of accomplishing the diversification yourself. The second type of diversification, I'll call it institutional diversification. And I'll give you an example. My grandma died in June, and I went with my mom and my uncle to 6 different banks and closed out 20 different CDs that my grandma had had. So in my grandma's mind, having money in 6 banks was better than having money in one bank because if one bank failed, her reasoning would be, she still had the other 5 banks worth of deposits to draw from. And I'm not going to say that this is a bad idea. The idea behind it is going back to the Great Depression when various banks failed, and it's certainly the case that you can have one bank fail and other banks not fail. More often, the banks are probably tied together in such a way that whatever might impact one bank negatively is likely to impact every bank negatively. So if that's the case, you want to do a little bit more to diversify from an institutional standpoint than simply open up accounts in 6 different banks. Obviously, FDIC limits are something you want to watch out for, so if you feel like any deposit that you are going to make into any one bank would exceed the FDIC guarantees that you have, obviously in that case you'd want to spread your assets around to different banks. But another sense of diversification is going to be don't just rely on banks, but place your money into different institutions in various sectors of the economy. So for instance, banks and credit unions might be one sector, insurance companies might be another sector, brokerage funds might be another sector, mutual fund companies yet another one, stock market and other bond instruments might be another. And so by spreading your money around to the various different institutions, the idea would be you are reducing your risk should any one sector or any one institution or any one institution class suffer from some liability or experience some kind of a negative downturn in the market where the others are not quite as impacted. So once again, the idea is to simply introduce variety into the ways and the places that you put your money in order to protect you against downturns in one area or with one company or with one sector or with one type of investment. The idea is if you have your money in enough buckets, you can somewhat guard against it. Now, I should interject, Warren Buffett is on the record stating that he thinks diversification is essentially an expression of ignorance. According to Warren Buffett, if you really understood a company or really understood a sector, you could with confidence invest your money into it, because if you understood it and you thought that it was good, then he said there's no problem with you being not diversified because you understand the market. But to the extent that you don't understand, to the extent that you think some of these things are highly mysterious, to that extent he thinks you ought to be diversified, or at least he thinks diversification is a reasonable approach. Essentially, they're simply spreading your bet around. But the third type of diversification, and the one that some people are unaware of or they don't think about in terms of a conversation of diversification, is going to be tax diversification. To introduce this part of the conversation, let me say that there are two general ways to think about tax situation. The first way, I'll introduce the term tax qualified. So by qualified, all we mean is that there's a special arrangement with Uncle Sam. So if there's a tax qualification, we mean that the Internal Revenue Service has some special status with respect to whatever that vehicle is. They've given certain privileges to it, certain tax breaks maybe. And so there are vehicles, and in particular retirement vehicles, which we'll mention a few in just a moment, that are tax qualified in this way. Well, the opposite of being tax qualified would be not being tax qualified or non-qualified. So in a non-qualified asset, essentially there are no tax breaks. There is no special arrangement. Given that brief background, let me say that there are three different types of taxable vehicle, or three tax buckets. The first tax bucket is just going to be the non-qualified bucket. There's no special break. You might have your money in a CD, you might have your money in a savings account, a money market, and there are no special privileges. Every year you're just going to get a 1099. You're going to pay tax on the interest. You pay as you go. But amongst tax qualified buckets, there's actually two different types. One is the tax me later bucket, and one is the tax me now bucket. The tax me later bucket is probably the most familiar to people. That's going to be your 401k or your traditional IRA. And in that case, the money you put in, you get a tax deduction the year you put it in, it grows tax deferred, and then you pay tax on everything when you go to take the money out. With the tax me later bucket, which is preeminently the Roth IRA, you basically do not get a tax deduction on the money you put in. It grows tax deferred, but then you don't pay tax on the gain of the contract even when you go to take the money out, provided you're 59 and a half and the contract has been in place for 5 years. The idea here is you want to think about this in terms of where you think taxes are going to go. The reason to favor a tax deferred bucket, like the 401k, is if you think that taxes are going to be better for you in the future than they are now. So many people think we're going to take a pay cut when we retire, we'll be in a lower tax bracket, and we're going to save money on tax. And this is a possibility, and it certainly was the case when the 401k first came out. The danger here is that if taxes go up, if the tax rates are raised, then even if you're in a lower bracket, you might end up paying more in taxes simply because Congress has raised the tax rates. Now, why might that occur? Well, when you think about it, the national debt was $23 trillion just a couple of months ago, and now it's at $25 trillion, in part because of the CARES Act, which has been put in place as a result of the coronavirus pandemic. And so this has added on a couple $1 trillion onto the debt, and some people don't see much of an end to this, that the debt is simply going to climb and climb and climb. And one of the dangers there is that ultimately it may result in Congress having to raise tax rates. The Trump tax cuts end in 2025, and after that, the tax rates will have to be reset. But if they have to be reset, they might be reset quite a bit higher than they are now. So in some people's minds, you don't want to put all of your eggs into the 401k basket, because in that case, you're betting taxes will be better for you. Rather, it's better to spread your risk around at least over the two buckets of tax me now and tax me later. And some people, again, also think about the tax me as I go bucket as being a potential for diversification here as well. There are no easy answers here. I have other videos where I go more in depth into some of these questions, but if you found something of use in this video, please like it, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you.